with the entrepreneur, and you have to decide on a team, or you have to decide on one of the entrepreneurs, and you have to invest in one entrepreneur. Therefore, that term sheet and how you generate that term sheet is fairly critical to your success as a VCIC team. And I always want to emphasize that there's economics in the term sheet and then there's control in the term sheet. And they are both important. No investor only looks at one or the other. They always look at both of them in conjunction. And so as you're negotiating, if you're giving a little bit on the valuation side or the economic side, maybe take a little bit on the control side, but be reasonable about that back and forth. Because that is exactly what any real investor does. One of the reasons it's so complex, though, in this term sheet is there's all this preferred stock stuff in there, which is atypical from anything you've ever heard of in the public market. In the startup investment world, it's a specialized version of preferred stock, and we'll get into a lot more about what that means in the next few slides. But there's certain rights and terms and whatnot for this preferred stock that's extremely important to understand. On the economic side, valuation or pre-money valuation, and all these other things you'll hear in the next few slides are very important, but there's also other things that go into the economic side around downside protection. And of course, control. I mentioned the closing conditions a little bit in conjunction with the key hires. The board composition being fairly important, of course, too, and we'll get into those things in the next few slides, too. So, starting off with the board of directors, this has got to be odd. It should never be even. So, if it starts at 3 board members, because it's a fairly early stage company, that makes a lot of sense. If it's a 7-member board for a company that's pre-revenue, that's really, really kind of big and unwieldy. There should be some, hopefully, balance in that board of directors as well. And typically the way they do this is they have some investors kind of balancing out the entrepreneurs or the executives from the company, and then also an independent person that they can mutually agree upon to bring into the board so that things are at least a little bit balanced. If the investors own half the company and they only have 1 of 5 board seats, that's not going to be in the best interest of the investors, and so that's a negotiation point on the control side. Protective provisions and closing conditions, there's a link on the bottom of the page there, but more importantly, there's also some best of links at the end of the presentation. I'll mention that again. There's some great links to example term sheets, which is very helpful to see a nice version of term sheet all the way to a really, really kind of more formalized and very verbose version of a term sheet. So we'll mention that later on. But there's ways of structuring it into the term sheet to make sure that you're protected as an investor. And again, preferred stock characteristics. There's a lot of things that kind of go into that. This is more of a higher level presentation, so I'm not going to go into a lot of details about that. A lot of this is available on the Learn VC website, and I do link a lot to external websites that have a lot more expertise and such than I do. Mostly venture capitalists themselves that blog about this type of stuff and give a lot of good details about how things work exactly. On the economic side, there's 2 chunks, if you will. There's valuation and then there's downside protection. Everyone focuses too much on the valuation side, and the entrepreneurs do especially too. It's all pre-money valuation and how do I look at that and why is that so important. But there's other ways of getting the same valuation metrics out using other terms that people don't focus on as much. And understanding that in totality is the way to actually go into the negotiation for VCIC. On the downside protection, there's things like liquidation preference, which basically means that I, as an investor with preferred stock, get my money back before any common shareholder gets their money back, so that if I put $5 million in and the company sells for $2 million, I get all $2 million. There's more examples of that on the website again, too, but and also understanding anti-dilution, meaning that if they're really, really hitting on the pre-money valuation being really high, I could put an anti-dilution clause in there that means that I can adjust my price later if I overpaid for it today. Because the next round will be at a much lower valuation, potentially. So, some terms, I probably should have done this before, but let's do it now. The pre-money valuation is the negotiated value of the company before any investment's made into that company. So, if you're, and I actually have an example on the next slide, so let's wait for that, but the post-money being the pre-money valuation of the company plus the amount invested into the company equals your post-money valuation. So you kind of get where that kind of comes from, pre and post. The option pool, which is a plan set aside, some shares so that we can incentivize employees later on. The creation of that is critical to the valuation or understand the valuation part of things. and the other ones that you can see in there, we'll just kind of skip across. So let's actually look at a real example here. So let's say the company's pre-money valuation is $1 million. The VCs are putting in $1 million. Therefore, the post-money valuation is $2 million. Well, the important thing here is to understand that you have existing shares before the investment. Let's say there's 1 million shares existing before the investment comes in. That means that the effective price per share is $1 per share of all the shares. Now, when you actually put that $1 million in, that new money comes in, you create new shares. You don't buy shares existing. In almost all situations, you create new shares. And again, that's using that same dollar per share kind of price to make it easy. The dollar per share is used because it's a fully diluted on an as converted basis price. That doesn't mean a whole lot to you right now. That's totally fine. But there's a reason that they actually do talk about the price per share of common and preferred being the same price. Now, understanding that,